All right, guys, so we've got a very interesting stock to take a look at today. Vislink Technologies Inc. VISL is our ticker. And I want to go over a couple of points and take a little bit of an analysis and see if we could have predicted this explosion here from 150 to over 350. It actually was almost $4. I mean, it's a monster move. And then up closing at right under $3. So you're looking at pretty substantial move, about 100% profit. And it was there. This is the daily chart. It was there for almost 2 full weeks in that price range, $1.50, $1.80, in that sort of range, $1.40, etc. So first off is this here is essentially like a flat board, or it's like a double bottom. Even though these wicks, the body of these candles are a little higher than the body of these candles. When you're looking at the wicks at the bottom here, I mean, it's generally at the same level. So, if you can draw a horizontal trend line across the bottom and, the wicks hit it multiple times and don't really go under it too much, but they hit it both on the double bottom or just this flat board, then you can correctly assess this. It's not exact. So even though this is a little bit higher, the bodies, a lot of times I'll use the wicks as a general point for if I'm establishing if something is a double bottom or a flat board or not. So it's very important when you're looking at potential divergence. So we're going to go over divergence here now. So now that we've established, this is really important, right? Now that we've established that we're essentially at the same level here, we can see that if an indicator is strengthening, like the stock RSI, like the RSI, right, and even more slightly the MACD and the CCI, right, it starts to sort of create a story. And so we're seeing these strengthening indicators even as we're establishing sort of a double bottom. And this is across the board. What's happening here with the tricks? Well, the tricks we know and love, because it's more about the general area of being overbought or oversold. So the fact that we went way down here to negative 2.2 or whatnot in that range, right? Negative 2.16 is where we're at now after this pop up. We were below that. We were like negative 2.2 or negative 2.3. So we were below that. And so the fact that we're way oversold on the tricks, on the daily, right? And then on bullish divergence, as these indicators were showing some strength. I like the fact that the MACD, this orange MACD line, is really flat. I love flat boards. And as I say a lot, but this is just what I've learned over the years. Just these patterns and sort of the conflation of what's happening, and seeing if I can create a story. And if there's not an obvious story, we just change the chart. There's thousands of stocks and commodities and crypto, and there's just thousands. I mean, there's so many. ETFs and ETNs and indices. I mean, there's just so much out there in terms of markets. So, if you don't love a setup, then just dump it. Just skip it. But this, I think, it looks really compelling with all this divergence across these indicators. This tricks oversold, etc. Here's another thing that I want to point out that I don't think I've talked about in these videos, which is the fact that, so let's say you've got this pinch down, right? This little V on the ADX. Okay, if it's if it's not coming down after you're seeing, 2, 3 in a row, then that might suggest that we've got some strength coming on. But it is coming down, right? Because we're already pulling down. Okay, this didn't pull down here, pop back up again, but then it came down again, right? 4 or 5 days in a row. And then it came back up again here, but then it pulled down here. So every time, almost every single time we see this V, this red V forming, we're pulling, right? So, and then here we see another V, and another V. And so now we're pulling a little bit here. We come back up. And then now this V, we're pulling. So, I mean, this entire trend is clearly down, right? And we're going below the EMA, right? We're popping up above it a little bit, but we're steadily, the EMA is going lower, and we're ended up going lower. So, and then we totally saw this is sort of a V that creates the flat board and all that stuff. But, just the fact that, this is sort of an upside down mountaintop. It's whatever this red line is pointing to, the minus DI line is pointing to. That's generally where the price, is going to go. However, only if it's a bear market, right? If it's pointing down, and only if it's a bull market if it's pointing up. So this is pointing down, and this was a big drop, right? It went from $3 to 280, all the way down to like a buck 40. I mean, this is a big drop. So on a percentage basis, I mean, this is still big, but it took a while, and then this happened in like a couple of days. So very interesting, very quick. That's what happens when you get down to like $3, $2, a buck. Is like a big move, is a big percentage. From 4 to 3 is a big drop. It's a 25% drop, but from 2 to 1 is a 50% drop, and from 1 to like a penny is almost 100% drop. So, that's why once you get in like these zones, you could lose a lot quickly and you can make a lot fast. So that's why you want to be very strategic when you're getting into stocks, especially stocks that are going to be really low in terms of the value of each share. Once you start getting into those numbers, your volatility can spike tremendously, and it'll like really have an effect on your bottom line. I mean, that's what's most important, right? So that's why when we get down in these levels, it's really important that you've got a really good, solid strategy, and you position size, etc. So this pinch down was phenomenal for those who were short, because you're making money all the way down here generally, but then this move is just phenomenal. It's an astronomical move on a percentage basis. Pretty much 50% drop within a week. That's pretty stellar. $100 stock like to drop to 50. For you to see that kind of a return on the underlying. So, but now what's interesting? You always want to look at, okay, well, we've seen this market dropping, and obviously we're going to look at different time frames, and there's a lot of charts. There are a lot of charts that we're going to look at. We're going to look at a conflation of evidence. However, let's just look at this chart for right now. When does the market get tired? Right? Because markets get tired. I mean, a bull market, they will get tired eventually. So that's what's happening here. So this, and I'm going to circle these. So this pinch down, okay, and then it's very imperceptible. But this pinch down, and then that pinch down. So now you've got 1, 2, 3 pinches down on top of this one. So this one, if you see, it pinched down here, right? Like right there. This is where it was pointing down. Well, the price pulled down and then snapped back up. You see the body of this day, it pulled down, but then it snapped back up. So the bulls are definitely, more in charge, at least that moment, right? It happened a little bit up here as well when these things pulled down and the bulls were in charge a little bit, but then the next time it pinched down, then we started coming down. So I mean that we were still trending lower. So let's circle these. So I'm going to circle these. So I call that a down pinch. So we've got essentially 4 down pinches here. And I know half you guys think that I'm just wacky, because this does look a little bit wacky, but this is just stuff that I've found over the years, and it's served me well. I know a lot of this stuff is not in like the most popular trading books. It's kind of wacky and wonky, and but I think it's interesting. So, and I think it's actionable. So you've got the ADX red line pitching down here, but the price isn't pulling down. Right now, let's see what happens again. It pinches down again. Again, the price doesn't pull down. In fact, it doesn't even go as low as this. So there's a story here now. There's a story here. We pinch down again, right? It's like, oh, it didn't even break 150. Started pinching again, and then now the 4th time it pinched, boom, right? It pulled down, it stayed up, and then here, the wick came down, but then it snapped back up over 150. So I'm going to circle this. So since this pinch, all of these were the days that landed on these 4 pinches. Well, it's not a coincidence that those 4 down pinches, this price, if you were to sort of step back and take a sort of a macro, a bird's eye view, it looks like a double bottom. It looks like a flat board, essentially. I mean, this looks like a pretty solid support level, right? I mean, we were establishing a support level. Because if the bears were still in charge, this thing would be trending lower. We would have spiked back up again, maybe hit the EMA, and then we would have come lower. These might have, dropped below 130, 120, 110, and then the bodies would have been below 130 or one, but that's not happening. We snapped up, we came down, none of these bodies. So if you look at these bodies, we haven't even closed below 150 for 7 days. 1, 2, 3, 4, 5, 6, 7 days. Because this green is above 150, closed above. So 7 days, right? So that was the last time we closed below 150. So you have 7 days in a row where we closed above 150. And yet we're seeing this line had pinched down. So that could have been a continuation. This could have pulled down based on this. It didn't. It came up. And then this one, and then this one. So you're looking at those 3 pinches down plus this one originally, but let's just look at these 3. But the price for 7 days in a row did not close below 150. So it's establishing a base. The bears are now like firmly losing steam. And so we're looking for other potential pieces of strength, underlying latent strength. And that's what I look for when I see how is the market responding to these down pinches of this red negative DI line. And so let's just call this a double bottom. And let's just look at this again. The bullish divergence, right? If we're looking at this stuff, bullish divergence on all these indicators. Trix is way oversold. It is no shock that we spiked. This is a massive spike. And you're talking about from right around 150 to $3. I mean, that's 100% return. If you got out at 350, that's even more. That's a phenomenal move, astronomical move. Now, what's great about this as a setup is, your stock is really low price. So if you can take a small shot, and make sure your position size, and, I like to think that unless I'm in a really aggressive mode, some people depend, it's all based on age or their aggression, their risk tolerance, their volatility tolerance. There's a lot of factors to come into play. But when you have a low value of a stock, you really want to respect that. At the same time, you could really make a nice return on that, like dollar amount, if you can strategically like get in, and you can get a lot of shares, obviously, but it doesn't really matter because it's all about just the dollar amount. the dollar amount that you're able to make. I mean, unless you're doing options, which are leveraged and all that stuff. So, but that's a total separate video. But this is just trading the underlying. I'm going to spend a lot of videos just talking about the underlying, just trading futures, just trading stocks, just trading forex, etc. So, 7 days you could have looked at this, thought about it, talked about it, ruminated on it, studied it, and finally decided, you know what, this is showing strength. This is a good place to take a shot. So I'm going to put my stop. Where would you put your stop? Well, probably below that level here. So, maybe 120. I don't know exactly where that, it's right around 120, 115. So you're like, all right, I'm going to go in at 115. I've got to stop in at 160. Or I have my, the stock is at 160, you know. So 50 cents divided by 160, or, 50 cents divided by 160 is like 30%. That's a very, very wide place to put a stop. However, why would your stop be that wide? Well, because it's possible that, as we've seen here, the price gets pulled down as a head fake. The head fake happens a lot, especially before a major move. So it happened here. Now it clammed all the way down. What's interesting is it didn't come below this, but it could have. It could have easily come below that. So you want to put your stop below that bottom wick because it's possible that we break through that wick. But we just want to go way below all the activity. So on a percentage basis, yeah, it looks like it's a huge, like, wide stop. Oh, I'm going to put my stop in, 20% below my entry. But it's a $1.50 stock. It's not like you're trading a $100 stock. So it's very, very different. And you have to play, if you decide to get into, for example, a low value stock, you have to understand the rules of that game. You have to understand the terrain. You have to figure out, okay, what percentage of my capital? It's probably going to be less than 1% of your capital. There are some, I've talked about, 10 or 20 positions, so you're looking at between 5 and 10% of your capital in any one stock. However, or on any one idea. However, it all depends on, what it all depends on, what the value is of that stock and what the anticipated volatility might be. So here we're risking 30 cents, but look at the return. The return was $1.50. It's a monster move. So you're literally looking at a 5-to-1 risk reward ratio in terms of that hit. And if you'd gotten out here, for example, you're looking at 6 or 7-to-1. So I mean, that's phenomenal. I'm not saying it happens every day. I'm not saying it happens every single time. However, this is, I think, an interesting setup. I think it's really important to continue to assess when you think the markets or the market that you're looking at has established a strong support level, flat boards, double bottoms, triple bottoms on divergence, etc. And then not have your stops too tight. Decide on what amount of capital, small or large or medium, and then once you've made that decision, say, all right, I think we could potentially see a strong move. And then once you see that risk reward, if that reward pays off 2-to-1, 3-to-1, 6-to-1, then especially for these kinds of trades, you generally want to take this profit. And this is a huge move, 100% return on your capital. It's a phenomenal trade. You might want to stick around, but I would definitely pull off a pretty large percentage of my position on this move. Thank you very much.